All right, y'all, we have a ton of stuff to get to today on Real Estate Backstage. I'm going to jump in here pretty quick. We have the government shutdown, which continues. We're on day 10. As of the day I'm recording this, we have the FTC suing Zillow and Redfin, a handful of other lawsuits to cover as well. Now, if you're watching on YouTube or listening on Apple Podcast or Spotify, go ahead and subscribe to the show. That way you don't miss any future episodes. And if you are looking for the show notes with links to all the articles that we're going to reference, you can find that at realestatebackstage.com/episode 41. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO here at Bluefield. We're a 4-time Inc. 5000 company headquartered here in Greenville, South Carolina. We provide real estate brokerage, property management, and insurance services. And actually, as of this week, we are about to announce that we now offer HOA management services as well. We're super excited about that. We actually just brought someone on staff who's been doing this for decades, a guy named Jim. He's actually been a client of ours for many years. We've managed some rental properties for him, but he just sold his HOA management company down in Florida, moved up here to South Carolina, and now we've partnered with him to launch HOA management services starting here in the upstate of South Carolina. So we're super, super excited about that. More details to come. All right, so like I said, we're going to jump in here pretty quick. We're going to start with the government shutdown. This is according to RIS Media. Quote, as Congress faces off in another government showdown, trade groups are warning real estate and mortgage professionals to prepare for potential disruptions to their clients' closings. Although Republicans control both the House and the Senate, they don't have the 60 votes needed in the Senate to pass a spending bill. Democrats are refusing to back the Republican-sponsored bill because it lacks key healthcare provisions. Now, we've talked about this on the show before. You would think that with 100 senators, you only need 51, a bare majority, to get things done. But that's actually not the case. There are rules in place, primarily the filibuster, which is a rule in place in the Senate, which has a 60-vote threshold to get the vast majority of types of legislation through. Now, it is possible for the Republicans to dismantle the filibuster and change the rules so that you only need 51 votes. That's kind of the nuclear option. They don't want to do that because, well, yes, it would make it easier for them to get things done right now. It also would make it easier for the Democrats to get things done when they are eventually back in power as well. All right, moving on. So while the direct hit to real estate transactions may not be widespread, the ripple effects of political dysfunction in Washington, D.C. and the added economic uncertainty could put more pressure on an industry already battered by mounting affordability and inventory challenges. In a statement, Realtor.com senior economist Anthony Smith warned that certain areas with high shares of federal workers would experience the most direct impacts, especially if the shutdown drags on. According to the Mortgage Bankers Association, a shutdown might lead to worker furloughs at a minimum and more widespread layoffs if it's prolonged of some employees at key agencies that touch housing. Some of these agencies are already reeling from earlier federal staffing cuts, including the Department of Housing and Urban Development, HUD, and the Department of Veteran Affairs and Agriculture. Employees of these agencies work with lenders to process FHA, VA, and USDA mortgages. Additionally, some verification requirements for conventional loans backed by Fannie Mae and Freddie Mac could take longer or be more difficult to obtain in a shutdown. This includes employment verification for federal employees, verifying tax transcripts from the Internal Revenue Service, and verifying Social Security numbers on some loans, according to the National Association of Realtors. The NBA anticipates that most agencies have contingency plans to maintain essential operations during a shutdown, unquote. And now this is according to Housing Wire. Quote, with the National Flood Insurance Program, NFIP, set to expire September 30th, just as hurricane and wildfire seasons collide with the threat of a federal government shutdown, uncertainty is mounting for homeowners, insurers, and the housing market. The NFIP has faced repeated short-term extensions and lapses, including under the Biden administration 2 years ago. Between 2008 and 2012, Congress extended the program 17 times and allowed it to lapse 4 times. According to the Congressional Research Service, which published an NFIP lapse insight on September 25th. In past lapses, the FDIC and Federal Reserve issued lender guidance, while FEMA provided direction for its Write Your Own program, most recently in December of 2024, unquote. So the longest government shutdown in recent history was in December of 2018, and it lasted for 35 days. But historically, they are typically resolved very quickly. Just for fun, here's a quick reference. I'm going to put this up on the screen for you guys who are watching on YouTube. You can see the various funding gaps and full shutdowns over the past several decades and kind of correlates with which administration that occurred in. Of course, the most recent one was also the lengthiest in recent history, 35 days. At the time I'm recording this, we were on day 10 of the current shutdown. Now, I think the biggest risk is for properties that are in flood zones. As it mentioned in the articles above, The vast majority of these agencies, while some employers are on furlough, they're still keeping people there to keep the lights on and maintain bare minimum operations. Things might take longer, but things are still getting done. These agencies do have contingency plans in place. However, like I said, the biggest risk, the biggest issue right now is this total lapse in funding for the NFIP. So if you're trying to close on a property that is in a flood zone, unless the buyer is paying cash and they're willing to take the risk of closing without insurance in place, that lender is going to require flood insurance. Now, I should amend that statement. Just because the property is maybe partially in a flood zone, that doesn't mean flood insurance is going to be required. You definitely need to check with your lender. You want to get maybe an elevation certificate from a surveyor. There are different variables involved there. If you have a property where just a portion of the backyard happens to fall in a certain FEMA designated zone, like zone AE or something like that, doesn't mean you're necessarily going to get flood insurance. However, if the if the house itself is in that flood zone, depending on that elevation difference between the main level of the house and the ground level, you may or may not need flood insurance. But definitely check with your lender if flood insurance is going to be required for this transaction. Your file just got a little bit more difficult until this all gets resolved. Now, even though the NFIP funding has lapsed, there are still private flood options out there. So for example, you guys know that we have an insurance agency, Bluefield Insurance Group, part of our Bluefield umbrella. And while we do write a lot of federally backed flood policies, we also have access to carriers like Neptune, where we can do a private flood policy during this period of time. So it might be a more expensive option, but it is still an option. All right, so while we're in the midst of this government shutdown, Fannie Mae and Freddie Mac have both issued guidance waiving certain loan requirements in order to keep things moving. This is also according to Housing Wire. Quote, government agencies and enterprises issued guidance on Wednesday for mortgage lenders and servicers during the current government shutdown, which affects federal employees, services, contractors, vendors, and other businesses. Fannie Mae and Freddie Mac are waiving some requirements for lenders due to the potential inability to confirm income, reserves, tax, and Social Security information from borrowers amid the slowdown in government operations. Their guidance will remain in effect until operations are fully resumed. Freddie said it will continue to monitor the situation and may revise or revoke guidance if the shutdown extends for a prolonged period, according to a bulletin signed by Kevin Kaufman, Senior Vice President of Single Family Seller Engagement. Fannie Mae reminded lenders that the shutdown does not relieve them of obligations under laws such as the ability to repay standards in the Truth in Lending Act. The GSEs are waiving the typical 30-day limit for pay stubs, instead requiring the most recent year-to-date earnings statement prior to the shutdown. They're also allowing lenders to waive verification of employment if they provide documentation of their efforts to confirm the borrower is employed, unquote. All right, so last week we had Jobs Friday, but of course we didn't have the normal jobs numbers released from the Bureau of Labor Statistics due to the government shutdown. This is according to the Wall Street Journal. Quote, economists, investors, and policymakers usually spend the first Friday of each month poring over the latest government jobs report, but not this one. The federal government shutdown means the Bureau of Labor Statistics isn't issuing reports, sending anyone eager to learn more about the recently sluggish job market scrambling for alternatives. Nothing entirely fits the bill, but the proliferation of alternative statistics are helping to fill the gaps. There is payroll processor ADP, which uses data from more than 26 million workers at ADP customer firms to gauge employment. Job posting site Indeed produces an alternative to the BLS's job openings report. And newcomer Revelio Labs uses figures from networking platforms to get readings on measures including employment, salaries, hiring, and attrition, unquote. According to ADP, private employers shed 32,000 jobs in September. So ADP isn't necessarily the most accurate, most reliable source, but then again, neither is the Bureau of Labor Statistics these days. So take that for what it's worth. All right, borrowers are suing Optimal Blue and several key lenders, some of the biggest lenders across the country. This is also according to Housing Wire. Quote, a class action lawsuit filed in early October in Tennessee accuses software company Optimal Blue and some of the nation's largest lenders of violating federal antitrust laws through an alleged mortgage price fixing scheme. According to the complaint filed on October 3rd in a U.S. District Court in Nashville, the defendants exploited their control of the residential mortgage industry to orchestrate a price-fixing scheme that has inflicted substantial damage on plaintiffs in the class. The plaintiffs are borrowers who obtained mortgages between 2022 and 2025. Optimal Blue was previously owned by Black Knight before being sold to Constellation Software as part of Intercontinental Exchange's acquisition of Black Knight. Both current and former owners are named as defendants alongside 26 U.S. mortgage lenders that originated more than 7 million loans between 2019 and 2024. In a statement, Optimal Blue said, "We are aware of the lawsuit filed against Optimal Blue and many of the top lenders in the industry. We do not agree with the assertions made by the plaintiffs in this case, and we're confident that we can demonstrate how Optimal Blue's products actually foster competition in the mortgage industry. Until we work through the legal process to disposition this appropriately, we can provide no further comment." The lawsuit centers on two Optimal Blue tools launched in 2019, Competitive Analytics and Competitive Data License, which requires lenders to share an unprecedented quantity and quality of non-public, competitively sensitive, granular, real-time data covering every component of their residential mortgage pricing and profit margins. Plaintiffs allege this data sharing arrangement, the price of admission to this cartel, allowed lenders to coordinate pricing rather than compete, effectively inflating rates and margins. The platform provides real-time visibility into competitors' pricing, including loan margins, pricing adjustments, concessions, and loan officer compensation, which would not exist in a truly competitive market, they claim. When loan originators discover they are pricing below rivals, they raise margins without risking market share loss, the complaint continues. Because lenders monitor competitors' prices in real time, downward pricing pressure evaporates. According to the lawsuit, rate spreads, which is the difference between the annual percentage rate and the Consumer Financial Protection Bureau's prime rate, for mortgages issued by Optimal Blue's clients were 2.68 basis points higher than for non-users. Compared with their own rates prior to joining the platform, lender spreads were 9.6 basis points higher, even after controlling for pandemic effects and other factors, unquote. So I haven't really dug into this too much myself to take a look at the details here to see whether or not I feel they have much weight behind these claims, but just on their face from reading the article, it seems like they have at least some substantial evidence that they can use to back these claims. So this is an interesting story. Like I said, a lot of class action lawsuits that we're hearing about nowadays, and we will definitely continue to pay attention to this story as it develops. Now, speaking of lawsuits, the FTC sues Zillow and Redfin over its rental deal. This is according to Real Estate News. Quote, "The Federal Trade Commission is suing real estate giants Zillow and Redfin, alleging the two companies illegally conspired to eliminate competition in the rental listing market. In a September 30th complaint, the agency claims the companies violated federal antitrust laws when Zillow paid Redfin $100 million to have Zillow be the exclusive provider of multifamily rental listings on Redfin and its own sites rent.com and apartmentguide.com. The complaint was filed in the U.S. District Court for the Eastern District of Virginia, Alexandria Division. Zillow paid millions of dollars to eliminate Redfin as an independent competitor in an already concentrated advertising market, one that's critical for renters, property managers, and the health of the overall U.S. housing market. Daniel Garnera, director of the FTC's Bureau of Competition, said in a press release, "The FTC will do our part to ensure that Americans who are looking for safe, affordable rentals receive all the benefits of robust competition between internet listing services like Zillow and Redfin," Garnera added. The partially redacted complaint notes that Zillow, Redfin, and CoStar, through Apartments.com, dominate the rental listing space and competed fiercely for years before Zillow and Redfin made their deal in February. As part of that agreement, Redfin allegedly agreed not to compete with Zillow in the advertising of multifamily rental listings for up to 9 years. This means Redfin agreed to stop selling multifamily advertising, to terminate its existing multifamily advertising contracts, and to transition those customers over to Zillow, including by turning over competitively sensitive information to Zillow, its direct horizontal competitor, according to the complaint. The Zillow-Redfin deal resulted in the termination of some 450 Redfin employees who had previously supported Redfin's rental listing business. As part of the deal, Redfin agreed to help Zillow hire them, the complaint noted. In effect, defendants have agreed to transform Redfin from an independent and vibrant competitor that markets and sells its own ILS multifamily advertising into one of several websites that provide nothing more than a copy of Zillow's ILS listings, the complaint says. The obviously anti-competitive deal will mean reduced choice, higher prices, and reduced quality for multifamily rental advertising customers, the complaint added. A Zillow spokesman said their listing syndication deal with Redfin is pro-competitive and pro-consumer, expanding renters' access to multifamily listings across multiple platforms and connecting property managers to more high-intent renters so they can fill their vacancies and get more renters home. I don't understand how they could possibly say the deal was pro-competitive. I mean, you got to give them points for trying, but when you pay $100 million to, buy out your competitor and have them agree not to compete with you for up to 9 years, that's definitely not pro-competitive. A spokesman for Redfin said the company strongly disagrees with the FTC's allegations, noting that the partnership has given Redfin.com visitors access to more rental listings and are advertising customers access to more renters. By the end of 2024, it was clear that the existing number of Redfin advertising customers couldn't justify the cost of maintaining our rentals sales force. Partnering with Zillow cuts those costs and enabled us to invest more in rental search innovations on Redfin.com, directly benefiting apartment seekers, spokesperson said. The complaint alleges violations of the Sherman Act, Clayton Act, and FTC Act, and seeks various forms of relief, though no specific monetary damages were disclosed in the filing. The FTC has asked for a permanent injunction against the defendant's alleged anti-competitive conduct and structural relief to cure any anti-competitive harm, prevent any future harm, and undo the continuing effects of past harm, including but not limited to divestiture of assets, divestiture or reconstruction of businesses, and such other relief sufficient to restore the competition that would exist absent the anti-competitive conduct. The federal agency is also asking the court for an order requiring Zillow and Redfin to file periodic compliance reports with the FTC, unquote. So this is huge. They are not seeking monetary damages here. They are looking to completely unwind this deal altogether, which is going to be really harmful to Redfin specifically because as part of this deal, Redfin allegedly handed over a lot of sensitive internal information and, laid off 450 employees and help them get jobs over at Zillow. So I think this is a big task to seek to unwind all of this. And I think doing so is really going to be more harmful to Redfin than it would be to Zillow. All right, so speaking of lawsuits, of course, more lawsuit news. I feel like that's most of what we talk about these days. After this FTC lawsuit was announced, I think it was 1 or 2 days later, a handful of attorneys general from various states, 5 or 6 of them, I think, piled on and joined in basically a copycat lawsuit here. This is according to Inman. Quote, just 1 day after the Federal Trade Commission sued Zillow and Redfin over an agreement it called anti-competitive, a group of state attorneys general piled on with their own lawsuit. Attorneys general representing Virginia, Arizona, New York, Washington, and Connecticut sued Zillow and Redfin in the U.S. District Court for Eastern Virginia on Wednesday. On February 6, 2025, Zillow and Redfin executed an unlawful agreement to remove competition from this already highly concentrated market, starting with a $100 million payment to Redfin to exit the ILS advertising market, the attorneys general wrote. The group is asking the court for an injunction stopping the agreement and for other unspecified relief. The agreement involved Redfin hosting Zillow's rental listings in buildings with more than 25 units, as Zillow turned its focus to apartment rentals as a space for revenue growth. The company also struck a similar deal with Realtor.com early last year, unquote. All right, so you may remember that CoStar filed a lawsuit against Zillow over copyright infringement for, allegedly having thousands and thousands of CoStar copyrighted images displayed on Zillow's website. Many of them even had the CoStar watermark still on the photos. Well, Zillow has finally responded to that with a legal filing, bashing CoStar and requesting to transfer the lawsuit to a different venue. This is according to Inman. Quote, Zillow has hit back at CoStar Group in the lawsuit between two portals via a letter filed on Monday requesting that the case be transferred to the U.S. District Court for the Western District of Washington. The mega portal, which in July CoStar accused of stealing watermarked photos and using them on its own and partner sites, alleged that CoStar was attempting to weaponize copyright litigation for competitive pressure. Zillow also says in the letter that the move is consistent with actions CoStar has taken against industry rivals in the past. The filing came at roughly the same time that CoStar distributed an update to the lawsuit to media outlets, alleging that Zillow was continuing to use thousands of the company's copyrighted photos months after the lawsuit was first filed, and is now using thousands of additional CoStar copyrighted photos that were not identified in the initial complaint. This lawsuit is nothing more than a calculated attempt to misuse copyright law to sideline Zillow and lock in CoStar's control. The letter, penned by Zillow's attorney, Jamie A. Levitt of Morrison Forster, said. Levitt further argued that the CoStar watermark photos are legally provided to Zillow by their customers who give them license for use. These photos are provided by Zillow's customers who grant Zillow a license to use the photos and warrant that they have all rights to do so, the letter states. Further, Zillow has an established policy allowing copyright owners to request takedown of materials in which they claim a copyright, consistent with the DMCA. Rather than use this system, CoStar chose to shift the burden to the courts and file the instant suit without prior notice to Zillow. CoStar has not adequately pleaded its claims, and Zillow will seek a pre-motion conference on a motion to dismiss. So I think Zillow is making a really poor argument here. They're saying, hey, look, the people that gave us these images, that uploaded these images, they claimed, they warrant to us that they have the rights to use them, and they provide us a license to display the photos, which again is just kind of shifting the blame to the people uploading the photos, all the listing agents out there. So I don't know if that's really going to hold up. CoStar Group founder and CEO Andy Florence chastised Zillow for shifting the blame in the lawsuit to its own customers and noted that this behavior is part of a pattern. Zillow's shameful attempt to blame its own customers for its mass misuse of CoStar's copyrighted photographs is as predictable as it is unconvincing, Florence said in a statement. Our complaint against Zillow spells out in detail the many ways in which Zillow itself, not its customers, engaged in systematic wrongdoing. Zillow published tens of thousands of CoStar-owned images, including many clearly watermarked with our CoStar watermark, and Zillow profited from those images. Let's remember that this is not some isolated incident. Zillow was previously found liable for mass copyright infringement in a case against CoStar-owned Matterport subsidiary VHT, and its legal troubles are increasing exponentially. Zillow goes on to argue in its letter that the lawsuit should never have been filed in the U.S. District Court for the Southern District of New York in the first place because Zillow and any of its likely witnesses are based in and around Seattle, Washington. Meanwhile, CoStar Group is based in Virginia and does not appear to have any connection to the Southern District of New York, but according to Zillow, may have avoided the Western District of Washington to evade an unfavorable Ninth Circuit law and the circuit's experience in addressing issues surrounding copyright law. Now, Zillow actually does make a good point here, and this is the practice of venue shopping, where rather than file your complaint in the district court that's either local to you or local to the defendant, you kind of shop around and decide to file it in whatever district you feel is going to give you the most favorable outcome. This is a practice that pretty much everybody engages in, and I would love to see some reform there where you have to maybe overcome some burden of proof as to why it was necessary to file in that specific district. So Zillow does make a good point here, although CoStar seems to be making some really good points as well about Zillow's wrongdoing, the fact that they're trying to shift the blame of this copyright infringement over to their customers. So we're going to keep an eye on the story as it develops as well. Now, speaking of Zillow, I'm sure you guys have seen or heard by now about the Zillow app now being built into ChatGPT. So this is a big move forward for OpenAI, for ChatGPT, the inclusion now of these third-party apps that are built right into the platform. So this is, I think, a trend that we're going to continue to see, where more and more people are doing their searching in the ChatGPT app rather than on sites like Google or other search engines. So rather than complain about it, we need to adapt to it and figure out how to get our websites, our listings, our messages to be AI friendly and show up in ChatGPT. Now, I'm going to show you, for those of you watching on YouTube, I'm going to share my screen with you guys. All right, so I went into ChatGPT and I basically just said, show me listings for sale in Greenville, South Carolina. It pulled from Realtor.com, from Redfin, Coldwell Banker, Remax, Allen Tate, pulled from a handful of different websites. But then it asked if it wanted to connect to Zillow. And I said yes. And I said, show me 5-bedroom homes in Greenville, South Carolina under 500,000. So you can see now it's got a map and it is pulling listings directly from Zillow. So I could click on these and I can get more details. And look at that. You can even request a tour, contact the agent. So this is going to be, I think, good for people who are customers of Zillow, like we are. Full disclosure, we do spend quite a bit of money every month with Zillow to purchase leads. So this is just another way for Zillow to create those opportunities for their premier agents. I know there's a lot of mixed sentiment about Zillow in the industry, either love it, hate it, somewhere in between. But the fact of the matter is, Zillow was very smart to connect with ChatGPT and make this a reality. Now, I'm sure we're going to start to see this from other websites as well. I'm sure Realtor.com, Homes.com, other search portals are going to follow suit and create an integration right in ChatGPT so that users natively within the ChatGPT ecosystem can access the listings from those various portals. So again, a lot of you maybe just automatically, instinctively, you're going to hate this because you hate Zillow, but this is the future. We're going to see these search portals not just live on their web domain or on an app on your phone, but they're going to integrate with these AI platforms. All right, shifting gears, the Supreme Court is not ready to let Trump kick Fed Governor Lisa Cook to the curb. This according to Inman. Quote, Federal Reserve Governor Lisa Cook can continue to serve on the central bank's rate-setting policy committee until at least January, when the Supreme Court will hear oral arguments on the Trump administration's bid to overturn lower court rulings that have thwarted the president's attempts to fire her. Cook is contesting the legality of President Trump's August 25th order, removing her from her position. The order cited allegations that she claimed 2 homes as principal residences. Cook has denied wrongdoing. U.S. District Court Judge Gia Cobb ruled on September 9th that Cook can continue to serve on the Federal Reserve Board while appealing Trump's August removal order, and it's unclear whether the allegations against her meet 4 cause requirements for removing Fed governors, and that doing so would likely violate her right to due process, unquote. So basically what the Supreme Court has said is that Lisa Cook can stay in her role until early next year when they take up the case and give both sides the opportunity to make their arguments. Now, I think that's good. That's pretty typical. She's going to get her day in court. She's going to get her due process. Now, here's the thing. There is a law in the books that gives the president the ability to remove somebody from the Fed if it is for cause. Now, that is a bit ambiguous, and that's what the Supreme Court needs to decide. And here's the other thing, too. From what I understand, the alleged mortgage fraud that she may or may not have committed by supposedly, allegedly claiming 2 different properties as both being her primary residence on 2 different mortgage applications. That allegedly occurred before she actually took on her current role on the Fed. So one question is, can you be fired for cause based on something you did before you were actually serving in that capacity? So that's one of the questions that we need answered. We need to hear from the Supreme Court on this issue so we can have a little bit more clarity on what for cause actually does or does not mean in this context, and just how much power the president does have, and just how independent the Fed really is. All right, moving on. Speaking of the Fed, Michelle Bowman speaks out on the deteriorating labor market. This is according to RIS Media. Quote, the Fed cut interest rates by 25 basis points at the September Federal Open Market Committee meeting, citing concerns about a weak labor market, seen through reports of increasing unemployment. This rate cut was made despite inflation rising as well, inching away from the Fed's still unattained goal of 2% annual inflation. Federal Reserve Governor and Vice Chair for Supervision, Michelle Bowman, indicated that proactive action might be needed to address the labor market in a Friday, September 26th speech at the Economic Forum, the Forecasters Club of New York. The topic of Bowman's speech, noted in her opening remarks, was her outlining her approach to monetary policy decision-making and the challenge that the Fed currently faces. Because our dual mandate places equal weight on both maximum employment and on price stability, when these objectives are in tension, it is important not to favor one side of the mandate over the other, she said, saying focus must be decided based on which of the goals is further from target or most at risk of deviation. Since 2021, that means focus has been tightening policy to keep inflation under control. Now, labor market conditions are demanding more focus, Bowman said. I have argued that increasing signs of weakening labor market conditions provide a basis for proactively supporting the employment side of our mandate, said Bowman, which seems to suggest lowering interest rates so as to boost the labor market. We are at serious risk of already being behind the curve in addressing deteriorating labor market conditions, Bowman added. Should these conditions continue, I am concerned that we will need to adjust policy at a faster pace and to a larger degree moving forward. Bowman noted concerns that inflation is not yet at the Fed's goal, but argued that annual inflation is within range, whereas the labor market shows more grave signs of concern. She argued that price increases from tariffs will be a one-time effect, and inflation is likely to trend back down once that effect has dissipated, unquote. So you may remember that Michelle Bowman and Chris Waller were the 2 members of the FOMC who actually dissented and wanted to start cutting rates 2 meetings ago. So if they had gotten their way, we would have started this rate cutting cycle a little bit earlier. And it sounds like she wants to be maybe a little bit more proactive, a little bit more aggressive in continuing to cut rates throughout the year to get ahead of some of the issues that we're starting to see on the horizon in the labor market. All right, in other news, final approval has finally been granted to the MLS PIN settlement. This is according to RIS Media. Quote, U.S. District Court Judge Patty B. Saris granted final approval to the $3.95 million settlement in the NOSELEC vs. MLS PIN Commission lawsuit on Monday. Right now, we are consistent with the NAR settlement, said Saris, further noting that the settlement agreement received clearance from 2 different Department of Justice lawyers and only had 2 minor objections out of nearly 650,000 class members. "I'm just inclined to approve this long fought for settlement," Judge Sarah said, adding that she hopes this will make the market more competitive in terms of broker fees. Before ending the hearing, Judge Sarah pressed Matt Gooden, the defendant's attorney, on what effects this might have on brokerages, but Gooden did not give a definitive answer. "Ultimately, it will be up for academics to discuss if it has the intended effects," added Sarah. The settlement amount landed at $3.95 million, which is equivalent to what the buy-in rate for MLS PIN would have been to join the Burnett settlement, according to Seth Klein, representing the plaintiffs. There are approximately 650,000 class members, and on average, if each of them file approved claims, each would receive approximately $6 before deduction of costs and any awarded fees and expenses, according to court filings. So, as always, it is the attorneys that win in situations like this. Just ridiculous. The settlement brings to a close a lawsuit that alleged anti-competitive practices related to buyer-broker commissions. Previously involved in the settlement, the DOJ withdrew its objection after MLS PIN removed offers of compensation from its platform. The first proposed settlement terms would have kept offers of buyer compensation on the platform, as MLS PIN is not affiliated with NAR and chose not to opt into the NAR deal last year. The parties and the DOJ engaged in extensive discussions about the settlement terms over a period of approximately 18 months, read court documents. The parties ultimately reached a FASA in May 2025 that includes both a settlement fund of $3.95 million and substantive rule and practice changes at MLS PIN to remove the alleged anti-competitive misconduct and bring MLS PIN's practices in line with the practices adopted by NAR and approved by Judge Bowe in the Burnett case. The settlement discussions have been ongoing for quite some time, with the first agreement proposed before the Burnett trial. During the hearing on Monday, Judge Saris noted that the case will go down in her record as one of her longest-running litigations, unquote. All right, shifting over to market news. Quote, "Sales of existing homes ticked down in August compared to July as sellers pulled homes off the market, and a dip in mortgage rates wasn't enough to nudge buyers off the sidelines. The U.S. is now on track to see a seasonally adjusted annual sales rate of 4 million homes this year," NAR said. Home sales have been sluggish over the past few years due to elevated mortgage rates and limited inventory, NAR chief economist Lawrence Yun said in a statement. However, mortgage rates are declining and more inventory is coming to the market, which should boost sales in the coming months. The seasonally adjusted sales rate of 4 million in August was up 1.8% compared to a year earlier. Meanwhile, there were 11.7% more homes for sale in August 2025 than in August 2024. Record high housing wealth and a record high stock market will help current homeowners trade up and benefit the upper end of the market, Yoon added. However, sale of affordable homes are constrained by the lack of inventory. Mortgage rates fell in August, but dropped more substantially in September. They now sit around the lowest point in a year, and given the lag time in the data, the impact of the rates may not be reflected yet, unquote. So while the existing home sales ticked down in August, the pending home sales actually jumped. This is according to Inman as well. In a sign of more home buyers revealing their willingness to get their feet wet in the market, pending home sales in August rose by 4% month over month and 3.8% year over year. Lowering mortgage rates are finally giving home buyers the confidence they need to shop in a more serious way, NAR chief economist Lawrence Yun said. Although pending home sales rose last month, Bright MLS chief economist Dr. Lisa Sturdivant noted that they are still low compared to other recent years, with buyers waiting for increased affordability and sellers taking their homes off the market in discouragement. All that is to say the outlook for fall may not be quite so sunny. So obviously those are national numbers and every local market is different and unique. I'm not sure what you guys are experiencing in your local market, wherever you are. Here at Bluefield, again, we're headquartered in Greenville, South Carolina, but we also work in Columbia. We're licensed in North Carolina and Georgia, so we do transactions on, across those borders as well. Normally what we see is our number of pending, we track it weekly, not monthly, so we normally start to see our weekly new contracts submitted trend down. That usually starts in maybe early August, and it continues to go down as we go into fall and winter time. It usually bottoms out right around New Year's, and then the second week of January, we start to see that trend back upward again. It is mid-October, and we're actually going to be setting a record this week for the most new contracts ever submitted by our agents in a single week. So we've been talking about this the last several weeks in a row in our leadership meetings, where it has not slowed down for us. It actually seems to be picking up a little bit, which is really weird for this time of year. We could probably partially attribute that to the growth in inventory that we've seen in our market over the course of this year. Some of it, of course, is due to the easing mortgage rates that we've seen over the last several months. But I'm going to choose to just give credit to our freaking awesome real estate agents. So huge shout out to all of our Bluefield agents that are out there making it happen. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes at realestatebackstage.com/episode 41. And I'll see you here next week with another behind the scenes look at the real estate industry here on Real Estate Backstage.